Good morning. These are the things that matter most in Europe's market today. The region enters August near recent highs, but the proof test is no longer broad momentum. It is earnings quality, AI read-through, banks and rates, China exposure, and one underappreciated story: traffic and platform risks spilling over from U.S. internet stocks. The central question for private investors is simple. Can Europe keep rewarding selective earnings strength if global AI leadership, China demand, and rate sensitivity are all being repriced at the same time? Start with the Europe market setup. Recent Reuters and Google News-linked results showed European shares reaching or approaching record levels at the end of July, helped by technology and earnings support. But that does not mean the whole market is equally healthy. When the index is high, the useful question becomes narrower. Which European companies can prove earnings quality now, and which ones are only being carried by the global risk-on mood? In Europe, that matters because the market is split between AI suppliers, banks, luxury, carmakers, energy, and defensives. The cleaner side is companies with visible earnings momentum, balance sheet strength, and direct exposure to the strongest global themes. Pressure sits with crowded cyclicals, luxury names with China sensitivity, and high expectation technology names if global AI enthusiasm cools. For private investors, the practical takeaway is this: a record-level index can still hide a very selective market underneath. Second, the AI read-through remains important, but Europe is not the United States. U.S. earnings have again separated winners from weaker proof. Amazon and Microsoft-style cloud strength can support the AI story, while Apple and other product-proof questions show that not every large technology name benefits equally. For Europe, the transmission is indirect but real. ASML, Infineon, SAP, and selected power or data center suppliers need evidence that AI spending turns into orders, software demand, and margins, not just headlines. Potential beneficiaries are ASML if chip equipment demand stays firm, SAP if cloud monetization remains visible, and Infineon if the cycle broadens beyond one narrow AI lane. Pressure sits with semiconductors or software names where valuation assumes perfect execution. For private investors, the useful filter is to separate AI infrastructure proof from AI theme labels. Europe can benefit from the global AI cycle, but only company by company. Third, banks and rates are back as a Europe-specific test. Reuters results from the last trading days highlighted Société Générale enjoying record quarterly profit as the retail bank beat weaker trading. That matters because European banks can still benefit when margins, deposit income, and domestic banking franchises hold up. But the same rate environment can pressure real estate, leveraged companies, and rate-sensitive consumer names. Banks are not just a sector story. They are a test of whether Europe can absorb higher-for-longer financing conditions without damaging the broader earnings base. The cleaner side is banks with strong retail franchises, capital discipline, and resilient credit quality. Pressure sits with property-linked lenders, leveraged companies, and sectors that need cheaper funding to justify valuations. In plain English, the takeaway is this: higher rates can support bank earnings and still make the rest of the market more fragile. The underappreciated story is Europe's exposure to platform and distribution risk. U.S. internet headlines around Reddit and search traffic look American at first, but the mechanism matters globally. If AI search, platform algorithms, and changing user discovery alter where traffic comes from, European media, classifieds, marketplaces, and online consumer platforms can also face a weaker funnel. This is not the same as chip supply or cloud capex. It is the risk that digital demand becomes harder to own. The cleaner side is companies with direct user habits, subscriptions, strong brands, and first-party data. Pressure sits with businesses that depend heavily on search referrals, paid acquisition, or one platform gatekeeper. For private investors, the takeaway is that AI can help infrastructure winners while quietly pressuring attention and distribution businesses. The confirmation has to come from user growth, engagement, and pricing power. Here is the stock-led watch list: ASML, SAP, and Infineon. Does Europe confirm the AI supply chain story, or does valuation discipline return? Société Générale, BNP Paribas, and ING. Do banks confirm earnings quality, or does rate stress broaden? Mercedes-Benz, BMW, and LVMH. Does China exposure remain a drag, or does cost discipline stabilize margins? Auto Trader, Adevinta-style marketplaces and European media platforms. Does traffic risk stay a U.S. issue, or become a wider digital business warning? Market bias, selective, earnings-led, and globally sensitive. Europe can still reward strong companies, but the margin for generic theme buying is lower when AI-proof. China exposure, bank margins, and traffic risk are all active. The mistake to avoid is treating a high index level as proof that Europe is broadly safe. The better filter is confirmation. Which companies can prove earnings quality now, and which ones only share the theme? That is the Europe Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.